Hello and welcome to another video. You still have my poverty camera at the moment. This yoke, this really expensive yoke, is not working. It's really annoying. Anyway, how to spot liquidity. How to spot it, how to take advantage of it. I'm going to show you everything. I'm also going to explain what it is as well. Hopefully as short as possible, but it's probably not going to happen. So there's multiple different ways of looking at liquidity, but first we need to figure out what actually liquidity is. Then we're going to go onto the charts and have a gander of how to take advantage of it and also spot it. So what is liquidity? The market is literally the oldest thing we've ever done, trading. It is, I give you this, you give me something in return. I give you loads of these, you give me some of these. That is how the market works. Us retail traders can buy and sell whenever we like. Why? Because there's enough people in the market for us to buy and sell from. We don't realize that big players in the market can't just click the buy button. They can't just open up their MT5 terminal and click buy. Well, they probably can, but they have different methods of doing it. But they're not going to be able to get all of their orders fulfilled in one go. If they have billions, if they're putting $1 billion into the market at once, there needs to be $1 billion on the other side to take. Okay, put it this way. If I am a big player in the market and I want to get into the market, what we are looking for as retail traders, especially for trading from liquidity, is to jump on when these massive candles, before these massive candles appear, and ride the train. Think of liquidity when it's being swept, as the whole market in general, as like a freight train. Like it's literally like you don't jump in front of the market and go this way. Okay, the market isn't about predicting. It is about marking up clear areas and having a reactionary plan for when price reaches those areas. Yeah, simple. So how do we spot liquidity? Well, there's 3 different ways of spotting liquidity that I use personally myself. It's probably more. There is simple double tops, double bottoms, triple tops, triple bottoms, quadruple bottoms, quadruple tops. That is the first way. Or they don't have to be perfect highs as well. They can be very close. So like if you have a high right here and the other high is like right there, okay, there is liquidity resting above it. If it's the other way around, same thing as well. If it's something like this, then I wouldn't call it liquidity because there's too much of a discrepancy between the highs. So if there's a small discrepancy between the highs with a double top, triple top, sometimes you might see like five candles, or sorry, 3 tops. One might be here, one might be here, and the third one might be like there. Okay, they're not perfectly aligned, but they're very close. There's liquidity resting there. Okay, so as I said, the big players, they place an order and the market flies. But the only way they can get that order is by taking orders. And how do they do that? Stop loss hunting, liquidity hunting, whatever you want to call it. Again, the whole kind of concept is if they're trying to buy 100 million worth of bottles of dilute water, there needs to be 100 million in that one moment selling at exactly the same time. The best way they could do that is by placing their orders around liquidity, where there's a lot of resting orders waiting to be taken, stop losses. Okay, so let's jump onto the charts and have a real life world look at this. So I've marked up a few examples. Oh Rob, these are such in hindsight. Yes, they are in hindsight. You need to go back and do your own testing. Okay, I'm just going to show you the concept and show you a strategy. So the first one, as I said, is relatively equal highs and lows. The second one is going to be trendline liquidity, and the third one, which is my personal favorite one, it's previous session high and lows. Okay, these can all be done, but the general thing is liquidity should be, and it's easier spotted on higher time frames. Don't be looking for liquidity on a 1 minute time frame. Okay, you'd be like, oh, they're relatively equal highs there's my liquidity resting. It's not. Just 15 minute, to be honest, 1 hour up is the best to find liquidity, okay, in my personal opinion. So what you need to do, as I said, is identify where the liquidity is. So obviously we had a raising market right here. Again, these are cherry picked examples, I know, but I just want to show you the concept. Okay, so here we have what's called relatively equal highs. All right, now if this previous high was all the way up here, then fair enough. If you look, none of the body of the candles closed above this previous high. They went up, wick down. They went up, wick down. They went up, wick down. Okay, so the way I like to trade liquidity, and I usually do this on the lower time frame, is simply wait for a candle to engulf the previous ones and you can enter a trade. Okay, obviously this is the 1 hour time frame. Okay, this is a 1 hour time frame, I suppose, strategy. Now there are a few ways of increasing the probability of this strategy, and I'll show you. But as I said, look, you have relatively equal highs right here. You have your high here, high here. So what makes this area so important? Well, every single person that was going short, okay, going short, probably did something like this. All right. See, when it went up, came down, went up, and it came straight down, all these people went short here. Now, this is a situation where liquidity, remember, this is the hour time frame now. So this candle to this candle to this candle, there was a lot of liquidity built up. Now this example I wouldn't say is the absolute best example, but it still is an example. Why? Because we had relatively equal highs here. We went above. No body of the candle closed above. Now if a candle closed above like this, okay, let's say for instance a big candle closed up like that, I wouldn't necessarily call it liquidity sweep. Why? Because we've closed above it. Remember, this is on the hourly time frame now. So you can see here we kept getting rejected down. So wicks are your friends. Okay, when you see a wick, it means it's been rejected. All right. And then you see this massive one down. It broke this previous 1 hour candle. The second it closed, open up a trade, stop loss at the top. And then you always target in the next obvious area of liquidity. Okay, where's the next obvious area? Well, we have lows down here. You could say like this is your liquidity. It's best to get 2 lows matched up. There you go. There's liquidity at the bottom. Now, I always take profit before. So let's say that is your liquidity. I would take profit before. I always take profit before the liquidity swept. Again, what makes this liquidity right here? You have a low here and a low here. Remember, you have to, the way you need to be thinking about it is where's everyone's stop losses placed, okay? Anyone that's in a trade up here, and especially around here, okay, where their stop loss is placed underneath this low. Which means, and it matches up with this low, which intensifies the actual amount of liquidity that's going to be based there. So you can see here, again, that could have been a trade. Obviously, then we had the price come all the way down. And what did it do? It created equal highs here. So there's your liquidity resting. But then it managed to come all the way back up. And what did it do? It swiped out that liquidity. Look. You have 2 1 hour candles. So that's 1, 2, 3, 4, 5, 6, 7. 7 hours where people were shorting into the market. Okay. All their stop losses are above this high. All right. The second that high was broken, look what happened. Went up, left the wick, no body of the candle closed above, and it came straight back down. If you entered on the close of that rejection candle, you targeted the liquidity at the bottom. Look, we have more liquidity here. So again, relatively equal lows. They don't have to be perfect. Okay, it doesn't have to be perfectly straight like this. It can literally be like this. There's your lows. All and look, it's even across here as well. Look, it's actually loads of liquidity resting here. There's all your liquidity resting there. You've 1, 2, 3, 4. You have 4 lows. That's a quadruple. Okay, quadruple bottom. They don't have to be perfect. It means that all liquidity is resting here. Also take into consideration that we do have this low here, but the majority of the stops will be here and the rest of them will be here. So it's up to you and your abilities and skills, I suppose, and patience to see if this gets swiped and this gets immediately swiped as well. Sometimes we can just come down, tap, take a small bit out and go. But the thing is, if there's a tiny bit taken, the likelihood is the price could come down and take more, but sometimes it mightn't. So even if price just tips 2 or 3 points in to a lot of liquidity rested and we get a big reaction from it, that's enough for me. It just has to take out the bottom, okay? So you can see here again at the bottom, and look what happened here. The price came back up, and what did it form? Double top, relatively equal highs. All right, what happened when the price broke it? Okay, in this scenario now, we did close the body above. All right, so if you're really strict, you might not take something like this, but immediately after it was rejected. Okay, so again, the market isn't black and white. There are occasions where, like, I would probably consider this maybe like a B setup. Why? Because it did break above, but we still have had a rejection because the next hour candle broke underneath. Okay, and the next one went down, obviously went down as well. Again, if you got into it right after the rejection of that 1 hour candle close, red candle, you know, you could have had another trade here, again targeting the lows here. So the kind of whole point is that you're looking for places that are relatively equal high and low. And sometimes, like in this scenario here, you can see that we completely slashed right through and it didn't hold. But what also happened here? It came back up and retested. So it can turn into resistance as well. So when it comes to looking for liquidity, one of the easiest ways to spot it is just simply double tops, double bottoms, triple tops, triple bottoms, wait for price to come up, snatch those highs, snatch those lows, look for a rejection candle straight afterwards. This is the hour time frame, obviously, so these plays will take a long time to play out. But again, that's the point. One thing to really improve the probability of the play, I will tell you with the last one. But anyway, that is how to do it if you're just looking at the first method, which again is relatively equal high, equal lows. You can see here as well, look, after we did take out these lows, we blasted right through them. But you will find some resistance at big psychological numbers, okay? These big liquidity levels. All you need to do is find a low that matches up with another low that's previously hasn't been swiped yet, okay? That's all you need to do. The second one is trendline liquidity, okay? How do we spot trendline liquidity? Well, if we have 3 touches of a trend line, normally I would base that as trendline liquidity, okay? You can see here, this is actually a play I want to take on NASDAQ, and it is coming down. I hope it does not come down as we're doing this, which is a perfect example here. Look, I use what's called a 75% retracement as well on my plays. So this play right here, I'm waiting for it to come down 75%, which is the optimal place. You want something to come down in my mind. There's built up liquidity here in the 1 hour. I'm looking for it to come down, swipe it, and come back up and retest this line. Will it happen? We don't know. Anyway, so the whole point of trendline liquidity is that there are orders resting above this trend line. You'll probably notice when a trend line breaks, it snaps and flies off, or it snaps and comes straight back in. You can see right here, look what happened. Perfect example. You had a bump, and it did swipe underneath, but it came straight back up, and none of the body of the candles closed underneath. Can you see that? None of the candles closed underneath for NASDAQ, all right? And you can see it rocketed back up again. So when it comes to trend line liquidity, it's essentially the same as the other one. It's obviously just on a slant, okay? Now, when it comes to entering on these, that price action is a bit too messy. It's kind of hard to get a judge on where you would enter, but my entry style is usually just like, it's simple as an engulfing candle, like it's just a candle that engulfs the previous one, okay? Sometimes in the past, this one I'm swing playing, sometimes in the past I've used things like hammer candles. Like here you can see there's a hammer candle, it refused to go above, underneath. That is a bullish sign. You could always just take it like that, obviously, and then you would target resting liquidity above, which could be, let's say, around here, probably even something like here, or you can be a badass and target the next side of the trend line. So when you're doing trend line liquidity, I find the trend line liquidity works quite well, because when you have a really nice established trend, if you buy, normally you are okay holding to the very top. Now, what I would normally say is take half of your profit on the halfway point. Okay, there is, I can't even remember, there is a setting where you can draw a trend line and it marks out the exact middle. I don't know where that is right now, but again, what I would recommend is taking at least a halfway point or using the price on the left hand side. So that's trend line liquidity. Again, you need two, again, exactly the same with the double bottom and the triple bottom. Trendline usually are better with 3 taps. So after the 3rd tap, now you can do it after 2 taps. You can't obviously do it after 1, but in this scenario, if you did it after 2 taps, it would have worked. If you did it after 3 taps, which is this is the 3rd tap, it would have worked out really well. Here again, we had 1, 2, 3 taps. So what does that mean? There's going to be a lot of built up liquidity right at this trend line. So what can work? Wait for it to come up, slice, hit that trend line, form something like this, maybe an inverted hammer candle, whatever your entry criteria or model is, and then bump into the play and ride it right back down to the bottom trend line. And that's how you play trend line liquidity, okay? But the most important thing is that you have a defined line that it needs to go up, over or go under and leave a wick, all right? There are scenarios where the body can poke out a little bit, but you really don't want that to be happening to make it a real strong setup. Like let's say, for instance, NASDAQ now comes right back up here, hits this trend line, and it leaves a lovely wick all the way up here, comes right back down, the candle closes right back in the trend line. Perfect. Get straight into that play, okay? So that is how you do trend line liquidity. Now, one of the easiest ways, and one way you can, I suppose, keep yourself really strict with this, because this, the one that I've showed you now and the one previous I've shown you is very subjective, okay? A lot of people see different things. A lot of people see different trend lines. A lot of people see different high and lows. But one thing, what people don't see differently is session high and session lows, okay? So if we go on to, I'm just going to go on to the 15-minute time frame to make this a little bit easier. So if I have this plugin called Market Sessions, okay? So if we go in here and we type in, I think it's called FX Sessions actually, yeah, FX Market Sessions by, I'm not even going to say that name. When I open it up, I'm just going to show you, I trade in London session or New York session. I don't trade in Asian session. So when you're trading this strategy, okay, you're looking to work off the high and the low of the previous session. All right, whichever one is broken first, you take an opposite position and you try to take out the other side. Okay, so if I turn this on, you can see those are my settings. This is GMT +1. Okay, here are all my settings if you want to take them down. And all this does is it plots out a line of the high and low of each session. And you'll notice a lot, price will come up, take out the high, take out the low, and it will normally then reverse and take out the opposite side. Okay, this happens over and over and over and over again. All right, so if you look here again, I'll just show you some. So here we have the Asian range, the high and the low. Wait for the low to break. Red candle, red candle, red candle, red candle, red candle. If you bought on the first green candle, okay, what would have happened? Would have came all the way up and taken out the highs. All right. You can see here now again. Look at this. We did not take out the high here, the Asian range high, but we did take out the low. Now this was a news candle, but you can see what did we do? We went right all the way up, took out the high of 2 sessions, and then we went all the way back down again and went all the way back up again. Okay, look at here again. This is the Asian session. We came up, first red candle, we went all the way down. We did come back up now, but we did come down almost touch. Remember, I always say take profit before the break of the actual session low or the liquidity. But we did come down and break it. But if you did take profit here, it went back up, took out the London high. So this session here that isn't marked, that's the New York session, okay? I might actually turn that on again. And we came up, we took out the London high in the New York session. And what did it do? Came right back down and took out the lows. Took out the low of this and went right back up and took out the highs. So it keeps bouncing between these sessions. Now there are going to be days where this happens. Now obviously when it did break, which was right here, it just flushed all the way down. Now there might have been an entry here somewhere and would have lost, but again it doesn't always work out. Same here again. Look, we took out the Asian high, then we managed to take out the Asian low. See what happens here. Okay, we did have a massive bump up. Okay, so I actually remember this. So we did bump up, we flew all the way up. We took out hit the trendline liquidity. So if you mash all these things together, trendline liquidity, session high and session lows, and 1 hour or even daily double top, triple tops or whatever, you can have a really strong strategy. And the more of these things that line up, like let's say a trendline liquidity matches up with a triple top on the daily, and it also matches up with a previous session high. You have so much liquidity built up there that there's 2 things that are going to happen. That thing is going to Mars, or it's going to be a massive fake out. So that is essentially the whole concept. Like you see here again, we went to Asian session, we flew up, took out the Asian session. We also took out all these prior highs and we went all the way back down again. Look, we took out the London session lows, which is right here again, orange line. London session lows taken out. It's New York session. What did it do? It fully retraced, took out London session high. Say here it did not do that. Right now, oh god, it is coming down to my play. Please don't do it right now. I need to stop this video. It probably is not even going to work out now. Everyone's going to be in the comments, it didn't work out. But that is one of the easiest ways of doing liquidity using market sessions, simply because it's not subjective, okay? London session for me starts at 8 a.m. I start my Asian range at midnight my time and I stop it at 8 a.m. in the morning. Now, the range for London for me, I stop at 1 o'clock. If you're trading forex, it stops at 2:30 if you're trading indices, because you have New York session open, and we all know Nasdaq and indices go nuts when the market opens at that time. So just be careful of that. So that is essentially liquidity. I know it was a big one, but again, let's recap. What have we learned? We've learned that there's 3 types that I look for anyway: double tops, triple tops, quadruple tops or bottoms. Mark out those lines. They don't have to be perfect. Wait for price to come up and snatch them. Use whatever reversal type you want. It could be an engulfing candle, it could be your SMC or ICT stuff, it could be whatever it is. Get into the play. But look, this is what I will say. Don't be really strict and crazy about your entry types, okay? In my opinion, if the price takes a really big level, it doesn't matter what fucking like entry model you're looking for, make it simple for yourself, okay? Doesn't matter what entry model you're looking for, it's either going to reverse or it's going to keep going, okay? You can look for 50 million confluences, but at the end of the day, what's important is the level you pick, not your entry. Okay, it's your entry, but not your entry criteria. It is the level you pick. Okay, doesn't matter how many confluences you have. If you pick a good level, somebody picking the same level going, I'm going to buy when it hits that level, and you going, oh, I'm going to wait for this to match up and that to match up and this to match up. Yes, you might have more confluences, but at the end of the day, if it is a clear, good level, it's going to bounce regardless of whatever confirmations you have. So just be aware of that. So we have those. We have Trendline Liquidity. 2 touches. You can try it on your third one, but it's better to have 3 touches on a trend line and then a 4th one maybe. Excuse me. And obviously previous session high and lows. So if you're trading in London session, use the high and low of the Asian session. If you're trading in New York session, use the high and low of the London session. And one nice thing to keep in mind, if you stay in the direction of the overall trend, let's say the market is shooting upwards, try and get a liquidity sweep from the bottom so you can get into a long play. If you're counter trend trading, it's going to have a lower success rate for liquidity sweeps, but the counter trend trades do have the best RR. All right, if you are trying to get into a trend and you're trying to get onto that trend, but you're looking for the pullback, you're going to wait for those lows to be taken out, get in and fly back up. It's not going to be as good of an RR if you get in at the very top of something and watch it fall. But again, higher win rate going with the trend, higher RR going against the trend, because there's more of the move to capture if it's retracing. Do you get me? I've shown you the numbers, shown you the stats. As I said, it's up to you to whatever entry model you can. Other criteria are, if you can, make sure the body of the candle stays underneath whatever line you have, or above, depending on the scenario. If it does gently poke out a little bit, you can take the trade. It's going to be up to your discretion. But again, those are the 3 types of liquidity that I would personally look for. My favorite one being the previous session high and lows. It's the same for everyone. Okay, it's the same for everyone. It's not subjective, nothing like that. We all see the same numbers, we all see the same session times. Okay, and that's pretty much it. Like the video if you like this sort of educational content. Leave a comment down below if you feel like it's has helped you out, or if you have any questions. And if you do want to join our educational Discord where you can see all my trades and whatnot and so forth, link is in the description if you want to learn how to trade from me and see my trades. And that's pretty much it. Have a good one. Thanks so much for watching, and I'll see you. My alert went off. I'll see you in the next trade.